Disclaimer. Trading financial instruments carries risk. This material does not contain investment advice, nor should it be viewed as a personal recommendation, or an offer of, or solicitation to trade in financial instruments. Past performance is not a guide to future results.
Hello everyone and welcome to a new ETFX video. My name is Gonzalo Canete. I'm here to give you a fresh, quick, simple review of the global markets for this ending week. Today is Friday, 7th of June. This is the evening of Friday, so by the time I'm recording this video, I can summarize what happens on the market after the unemployment rate from the United States, the non-farm payrolls, the average income released today. Very interesting numbers because as you probably, if you follow these reports, you probably know already, Federal Reserve is basing the decisions on very related with the core inflation, which is mainly caused right now by the service sector, which is using high levels of labor force, and therefore labor market is the main trigger or cause for the twist on the decision of Federal Reserve. Now, before I release or I reveal to you what was the results, you probably already by that time know already, but I'm gonna just give you three data and also the impact of these three data. From these three different variables, factors presented today, two of them has been positive for the dollar, but unfortunately negative for the market. Only one of them was actually positive for the market. We're gonna analyze that later in detail. What is important also is that this week, it was not only the labor market data release today, it was also yesterday the interest rate decisions by Central Bank of Europe. And it was important because following these reports, I was mentioning in the previous reports that my expectation, our expectation, it was that maybe could be a kind of twist on the market, a kind of movement nobody was expecting, which it was cancel the interest rate cuts. Or based on what? Well, based on, let me set the screen with you, based on the core inflation presented by European Union and also by Germany for the last 2 weeks. We have seen the core inflation rising, just tiny bit, but rising, almost getting close to 3%. Well, if it's true that Bundesbank and the head of Central Bank of Europe, the really managers of the Central Bank of Europe are the German ones who are super conservative, ultra-orthodox economists, they should never, ever cut the interest rates if the inflation is still active or rising in Europe. However, what they did, it was actually cut the interest rates yesterday. Not even that, but basically we have also included in our morning report today the comments analyzing the words from Christine Lagarde yesterday, the president of Central Bank of Europe. And I believe they are assuming, implicitly, they are assuming that the inflation is here just for long term. We probably going to see that the next thing they're going to suggest is maybe 2%. They already said that yesterday. 2% is too ambitious. The target of 2% inflation is too ambitious, and therefore we should move to a maybe higher inflation, which is maybe 3% is a normal inflation. Who knows? So let's analyze the words. I just give you a summary today in our report, making a kind of short comment of all, summarizing all. Yesterday, the Central Bank of Europe decided to cut rates despite the last upturns in German and Eurozone inflation. This is in monetary terms means a capitulation in its battle against inflation. Simple like that. Central Bank of Europe policymakers warned that pushing inflation down to 2% target could be especially difficult, but say policies working as intended. The Bundesbank warned that sharply higher German waves this year could continue rising and market inflation storm, especially for services. We knew that because I already mentioned in our previous reports that the main problem with the core inflation was the services, because it's the labor cost what is behind inflation. Bundesbank Chief Nagel said the rate cut was justified, but the Central Bank of Europe wouldn't be on autopilot for further reduction, which basically means it's like we are cutting the interest rate now, but maybe we are not cutting the interest rates in the next meeting. Markets expect between 1 to 2 cuts interest rates this year, by a total of 4 interest rate cuts by the end of next one. Still holding rates above 3%. And then Lagarde say Thursday move likely started in daily back process but July action is unlikely. The next positive possible window for a cut will be September meeting of data supports it. If data supports it. So mainly saying like, okay, we cut interest rate now, we probably are not going to cut interest rate on July or on August, and probably the next interest rate cut will come in September. Well, this is interesting. You also got here the data, the trade balance from Germany released today, which it's also not so nice because it's not even dropping in super plus, which is an economy based on exportation. They need the super plus. It's dropping the super plus, but it's also dropping the industrial production, as you can see there. In the case of China, the numbers were good, but still the growth of importation is super low, and therefore is confirming that the main problem of China is the internal consumption and the internal demand, which is basically what China have been trying to develop for the last 10 years is a strong middle class in China who actually can replace the dependency they got of customers, foreign customers, mainly United States. Okay, say that we got the reaction of the data release after these comments. Federal Reserve decisions are on the radar, and today we got this data, which basically was the unemployment rate in the United States was moving from 3.9% to 4%, which it means if the unemployment rate is rising, it's a negative number for the economy, but positive for Wall Street because it means that the Federal Reserve eventually will pull the trigger and cut the interest rates if the numbers are bad enough to intervene in the economy. However, the next data we got, which is the non-farm payrolls, it was super strong. It was 272,000 versus an expectation of 182. As you can see, much bigger than expected, and therefore still showing us a powerful job creation in the United States, and therefore the economy is still shows resiliency. So the next one, it was actually the average income generated rising by 4.1% when the expectation was actually dropping from 4% in the previous period to 3.9% in this period. It didn't happen, even rise to 4.1%, and therefore retail sales, consumption numbers, all variables related with retail businesses, they're gonna eventually keep strong, and inflation gonna resist probably. Based on these numbers, we got a strong reaction on dollar getting stronger, and remember, if the dollar is getting stronger and rising, it means that the interest rate cuts is not happening, so far at least. SP 500 was dropping. We're gonna review now all the markets live. And the US government bonds, the yield was rising, which again showed all discount higher interest rates expectations. That was the reaction of the market. So far at the moment we got SP 500 that is moving. You see it's trying to recover the levels, but if we go to a smaller time frames, you can follow and see what was the drop. You see the drop caused by the data, it was here. So basically after those numbers, the non-farm payroll, the market was dropping, say, oh no, the economy is still strong, therefore we cannot expect a cut in the interest rate by the Federal Reserve, and therefore that means that the money is not coming to Wall Street. Let me share the full screen so you can see all levels in detail. Now, what happens after is the market is still pushing forward, pushing back, because we're breaking up new records on SP 500, the biggest equity index in the world. Let's say, I was mentioning in our previous reports that the top record resistance is 5,350, which is more or less here. And right now is at 5,380 mini Standard & Poor's 500, which means the market is still going to conquer those maximums. Even Nasdaq 100, you got on the screen right now, is also pushing above the 19,000 points main level, which again is also showing us certain change on the tendency. In the case of the dollar, is still super strong. Look how nicely it was jumping after the data. I want to show you in long term what was the levels. It was 104 points, the support of the DXY index, which is the dollar index. As you can see, the support was in 104, working, and boom, pushing back upwards. So that's the situation of the dollar right now, and therefore, obviously, consequently, the euro dollar was dropping. This is a move that we were expecting, but still is nothing comparing what we expect in middle or long term. Now, this is a reflection I want to share with you. Let me also show you a long term so you will understand what I'm about to say right now. Let's say that this is the tendency, and you can obviously detect the channel from here, and I believe this top maximum registry on this channel is showing us that sooner or later, either now, either in a euro dollar 1.1050, 1.11, 1.1150, at some point we're gonna see a massive twist on this pair, and it's gonna be dropping for a few months, moving probably back to parity or below the parity. I think that's the most probable situation we're gonna face in the coming months, and I can explain why. European Union is in recession. We have analyzing the numbers. GDP growth is super low and weak in European Union, particularly in Germany, which is the main economy of European Union. Meanwhile, United States is still growing, reducing the growth rate because the expectation was 2%. Then afterwards, review it was released by 1.6% growth rate for Q1 of this year, and then review downgrading the growth rate to 1.3 or 1.4% if I'm not wrong. So still dropping the growth rate of United States for the first trimester, for the first quarter, still in that case is much better than any growth rate in Europe, not comparing with United Kingdom, not comparing with Germany, not comparing with France. So that's why I believe United States is gonna still be one of the economies, main economies for capital markets. All the capital gonna move here. As you can see, also the bond is rising. But now, in terms of inflation, what I believe that instead of expect, let me set the full screen. Instead of expect an interest rate cut, which is what everyone is expecting right now, the market is discounting an interest rate cut from Federal Reserve by November and Central Bank of Europe by September. Well, the things could change dramatically if these numbers I want to share with you here are right. This is the Commodity Research Bureau Index, and it's showing us gold, industrial metals, oil, but also food is sharing with you wheat, cotton, what else? Well, mainly almost all commodities that you can find are collected and measured by CRB index. Now it's dropping a little bit here, yeah, but as you can see, it was breaking up the maximum registry during the 2002, which was the maximum inflation in 40 years. Now, if the index is in these levels, I believe we are not too far to experience again an increase on inflation, because based on this index, almost all commodities component, basket of full basket of commodities are rising in terms of price. But not only this one, I got also the WCI, which is the World Container Index, showing us again a very dangerous trend. As you can see, the last 15 years has been below that 5Ks, and now it's rising in a very similar pattern that it was doing by the end of 2021, starting on 2022, when we got a massive inflation hitting the West economies and causing a incredible shock on capital markets by increasing interest rates in a high speed. So we got already two indexes showing to you a potential inflation coming. We got a third one. The third one is, no, hold on. This is the research. I posted the same one twice. Yeah, let me see if I got somewhere else the previous one. The one I want to share with you is actually this one. It's the Baltic Dry, which is also showing us the cost of maritime or sea trade traffic. So it's rising again, as you can see, since 2023 has been rising, and therefore I believe this also gonna give us a kind of potential inflation signal. So we need to be very careful on these indicators right now. Things doesn't look really nice when we see this index rising. So I think that's my main concerns in terms of what's going to happen with the interest rates. Now, going to a more epic moment, I was just sharing this screenshot showing the reaction of the dollar and the reaction of euro dollar, because obviously, as I was saying here, we have seen as in the last minute when dollar seems to be already lost, losing 104 points, which was a support. Boom, the data release was pushing up the dollar. It was rising back again and punching the face of the euro dollar and throwing 70 pips down the pair euro dollar. That's why I believe the battle at the end is gonna be conquered by US over the euro area in terms of capital and market. I think that's all. It's a quick review of what happens during the week. There is many other topics that we can discuss, but I don't want to make this video too long. You can also, however, go to our section on the blog and review this on detail. As you can see, we also got a section for geopolitical events. The last scary news is that Russia has been saying, I think I mentioned here, Russian warships heading for Caribbean. US officials say Russia warships were traced heading to the Caribbean without prior Kremlin notification, as is the standard procedures. The move comes amid escalation tensions between Russia and the West over the war in Ukraine. Putin recently warned Russia could supply advanced weapons elsewhere to enable strikes on sensitive Western targets, basically trying to mirror the decisions by France, by Germany, by United States of providing long-range weapons, missiles to Ukraine and authorize them to use against Russian territory and Russian targets. I was just mentioning here, France officially authorized the use of long-range weapons to attack Russian targets inside of Russia, once again crossing the red lines drawn by Moscow to avoid a direct confrontation with NATO. Very interesting also the comments from the they're celebrating since yesterday until tomorrow, I believe, is the International Economic Forum of St. Petersburg. And we also, the comments done by Dilma Rousseff, which is the president of the new Central Bank for Development from BRICS, mentioned that we are actually moving to a multipolar order. Yeah, that's all. So you can just review the whole week here also. Alright, I think that's all. If you enjoy this video, if you really like it, please give me a thumb up and click on subscribe. And hopefully, I expect you to see here the next coming weeks. Leave me comments if you want. I had any kind of particular topic on the reports, or if you want we make actually a report on certain topic, please let me know and I will proceed. Thank you. Take care and have a good weekend. Bye bye.